So today we will be discussing the important things in the chapter assessment of charitable or religious trust and institutions. Okay, so first of all, you should know the first thing that you should know in this chapter. See, you can expect either a theory question or a numerical question. Normally they used to ask numerical question, but for the past few attempts, say 3 or 4 attempts, they keep on asking theory question. Okay, so what I'll do is I'll make you understand how to solve a numerical question so that you will learn the theory as well along with that. Okay, so we'll be starting with the charitable and religious trust. First of all, this charitable or religious trust, if you are a charitable or a religious trust, then you are eligible for exemption. You are eligible for exemption. You need to follow section 11, 12 and 13 while computing their taxable total income. If you are a charitable or religious trust, you are basically eligible for exemption, but you should follow section 11, 12 and 13 for claiming that particular exemption. This is what the department says. Now, first of all, this charitable or religious trust should be a public trust. This should be a public trust. If it is a public trust only, you can claim the benefit of exemption. Now friends, the interesting thing that you should know here is, I'll make you draw certain charts. This chart will actually help you in cracking the entire concepts in this particular chapter. So first of all, we will write this chart. So I want all of you to take a fresh page in your notebook and just copy down this chart, and this will actually help you in solving the problems. So take a fresh page and write source of fund. Source of funds of charitable or religious trust. Source of funds of charitable or religious trust. Now, first of all, as you all know, what all are the main source of fund of a charitable or religious trust? We can divide the main source of fund of a charitable or religious trust into two. Number one, income from property held by the trust. What do you mean by income from property held by the trust? The trust itself owns some properties and they are able to generate some income from the property. Say for example, they are owning a building, they are getting rent. They are running a shop, they are getting some revenue from the shop. Or they are having a fixed deposit in bank and they are getting interest. These kinds of things can be called as income from property held by trust. So number one, income from property held by trust. And number two, second type of source of fund is donations. Donations. Okay, so these are the main two sources of funds of a trust. If a trust is having income from property held by trust, you need to directly consider it as a taxable income of trust. You should definitely call it as taxable income of that particular trust. But from this also they are eligible to get some exemption that we will study later. Okay. So if a trust have income from property held by the trust, that have to be considered as a taxable income of that particular trust. Now moving on to the donations. Donations, we can split this donations into three. There are three types of donations. So we will split this donations into three. Number one, it is said to be donations with specific direction. The first type of donation is said to be donation with specific direction. What do you mean by donation with specific direction? It simply means you are getting a donation. Okay, you are a trust, you are getting a donation. The donor have clearly mentioned the purpose of donation. That means the donor have clearly or created a deed stating that this donation should be used only for a respective purpose. Say for example, we are an orphanage and a donor came to us. He donated rupees 1 crore and the donor told you build a building. You construct a new building for the purpose of your orphanage, and he will create a deed for that also. Okay, so the trust will utilize that particular amount only for the respective purpose. So this is called as was donation with a specific direction. What you need to do is, you need to invest this donation. The trust should invest this donation in specified modes. In specified modes mentioned under section 11 subsection 5. Specified mode means, say for example, in your bank account or in some listed securities or listed shares, they can park this fund. They are not supposed to keep that fund as money in their hands. Okay, so they should invest this amount in specified modes under 11 subsection 5. If they invest it like this, then it shall not form part of taxable income. Taxable income. It will not form part of the taxable income if the trust has invested that amount in specified mode. You should not bring it to the taxable income of the trust, not required, because it is considered as a corpus fund only. Corpus fund, or we can say capital fund. It will be considered as a normal part of capital or a corpus fund. It will not be considered as the taxable income of that particular trust. This is the first thing that you should know. So what is the first type of donation? Donation with specific direction. The trust should invest that amount in mode specified under 11 subsection 5, and it will not form part of the total income. It will only form part of the corpus or capital fund of that respective trust. This is what we should know. And the second type of donation we can call as anonymous donation. Second type of donation is said to be what? So it is called as anonymous donation. Now you tell me what to do with this anonymous donation. Anonymous donation have to be splitted into two. You have to split this anonymous donation into two. The first split we can call as specific limit. Specific limit. And what is specific limit? Either rupees 1 lakh or 5% of total donation, whichever is higher. Whichever is higher is said to be specific limit. So if you are getting some anonymous donation, first of all, what do you mean by anonymous donation? The donor don't want his name to come in any records. The donor, I know the donor, okay. It's not like one fine day I opened my door, I saw a box full of cash. It's not like that. That is too dramatic, okay. It's not like that. The donor, I know the donor, but the donor don't want his name to come in my records. Okay, normally the donee, the trust, have to collect a copy of his PAN, address, name, and the donee have to file a form regarding this is the donor, this is his name, this is his PAN number, this is his address. There is a a legal formality there when you are accepting a donation. But in this case, the donor don't want to disclose his name. So what department says, if you are getting an anonymous donation, no problem. You split that anonymous donation into two. First part is specific limit. And what is specific limit? Either rupees 1 lakh or 5% of total donation, means all the donations, including corpus, anonymous and other donations. You take 5% of total donation, whichever is higher. And what to do with that higher? That higher have to form part of the taxable income of the trust. That higher portion have to form part of the taxable income of that respective trust. This is what they are saying. Now, listen, how about the remaining portion? The balance amount have to be taxable. Taxable under section 115 BBC at 30%. The balance portion have to be taxed under 115 BBC at what rate? At 30%. This is what the department says. Now, this anonymous donation, this concept is not applicable for religious trust. Why it is not applicable for religious trust? See, as you all know, every religious trust or every church, mosque, temple, etc., there will be this offering boxes. And the people who donate amount to the offering box will never put a copy of their PAN card along with the donation. Will they? Will they staple a copy of the PAN card with the note that they are donating? No, never. So, department say, no worry. Religious trust is getting a lot of anonymous donation, but don't treat it like this. You can treat it as a normal donation only. So, we can write not applicable for religious trust. Not applicable for religious trust. It is only applicable for what? Charitable trust only, not applicable for religious trust. And there is one more type of donation, that is the third type of donation, that we can call it as a normal voluntary contribution. We can write other voluntary contribution. Other voluntary contribution. You tell me what to do with the other voluntary contribution. Directly put it as your taxable total income. All the other voluntary contribution have to be considered as your taxable total income only. So this is the first thing that you should know in assessment of charitable and religious trust. Trust have two main sources of income. Income from property held by the trust and donations. Income from property held by the trust means whatever the assets that they own, the income from that respective asset is said to be what? Income from property held by trust. Property here doesn't mean land and building alone. It means all type of assets that you own. If you're getting any income from these assets, this have to be assessed under what? Assessed as a normal taxable income of the trust. And how about donations? You split the donations into three. Number one, donations with specific direction. If you invest it in specified mode, don't worry, it will never form part of the taxable total income. If it is an anonymous donation, split that into two. Specific limit will form part of the taxable total income, and the remaining have to be directly taxed at 115 BBC at 30%. And other voluntary contribution, directly put it as a part of the taxable income of a trust. Now, the next question is this figure, that is the taxable income of the trust, do we have to pay taxes for this figure in full? The answer is no. Taxable income of the trust, you can claim certain exemptions and benefits. That's what we are about to discuss right now. So, first of all, you can claim 15% of above as deduction. Okay, how much ever is your taxable income of the trust, you can claim 15% of that as a kind of standard deduction. We call it as accumulation. Are you all listening? What do you mean by the concept of accumulation? Very simple, friends. Every trust can accumulate 15% of their taxable total income for their future purposes. That also means every trust have to apply 85% of their taxable total income in the respective year for their charitable objects. Are you with me? So, the theory is very simple. How much ever is your taxable total income, you split that into two. 15%, just like a standard deduction, you can claim. That is a kind of an accumulation for your future purpose. And the remaining 85% you have to mandatorily apply for the object of the trust in the respective year. What if you are not applying that 85% in full? Unapplied amount shall be, you have to pay tax on that unapplied amount. This is what the department says. Are you with me? So, we can write the balance 85% of amount have to be applied for objects of trust in that year itself. In that year itself. So, the balance 85% of the income have to be applied for the objects of the trust in the respective year itself. Are you all with me? So, you take the total taxable income of the trust, 15% you can accumulate. Accumulate means when it comes to the numerical question, it is similar to a standard deduction. But the concept is not a standard deduction. Out of your taxable total income, you take, just like keeping reserve. You are maintaining that 15% for your future benefits. So you can claim that 15% as a deduction when you are doing a numerical problem in examination. The remaining 85% you have to spend. We call it as application of money. You have to spend it for the object of the trust in that respective year itself. Now, when you are applying an amount, there are certain things that you should be careful about. Let's study all the application related things in detail. So listen, the first thing, say for example, these are related to application, okay? These are related to application. See, there is a concept called deemed application. In application, there is a concept called deemed application. What do you mean by deemed application? Deemed application simply means you are not applying it in full. Okay, but income tax department say, even though you are not applying, we will call it as application. Even though you are not applying it in real, we will call it as what? Application. This concept is said to be what? Deemed application. Let's understand what is deemed application. There are two scenarios for deemed application. Okay, we can split that deemed application into two. Split deemed application into two. Number one, amount accrued but not received. Amount accrued but not received is point number one. Number two, any other reason. Any other reason. So let's understand what is this amount accrued but not received. Say for example, you are a trust maintaining books in mercantile system. Okay, you are maintaining books in what system? Mercantile system. And in your books, in your taxable income of the trust, there are certain income which is accrued but not received. What do you mean by income accrued but not received? You earned it, but you haven't received it in your hand. Are you with me? So, unless otherwise you receive it, once you receive it only, then only you can apply it. First of all, you should receive that amount, then only you can spend it. Now in your books, since you follow mercantile system of accounting, this amount which is not received also will form part of the taxable income. But you cannot apply it. Why? Because you haven't actually received it. So what department say? Amount accrued but not received can be treated as what? Deemed application. Whatever the entire amount accrued but not received can be fully treated as what? Deemed application. But it is subjected to one condition. What is the condition? That amount have to be applied in the year of actual receipt. In the year of actual receipt or its subsequent year. That simply means, friends, listen, say for example, in 2023-24, 10 lakhs was accrued but not received. 10 lakhs was what? Accrued but not received. I can show this entire 10 lakhs as what? Deemed application in 23-24. But this amount is actually received in 2025-26. I received this amount actually in 2025-26. So there is a condition. When I actually receive it, I should apply this entire 10 lakh for my object. I should apply this entire 10 lakhs for my object either in the year of receipt or at least by the subsequent year. What is subsequent year? 2026-27. So deemed application is based on a condition that in the year of its actual receipt, I have to actually apply it for my charitable purpose, or at least by the next year, I have to completely apply that amount for my charitable or religious purpose. This is what the department says. Are you all with me? So it's a very simple point. I have to actually apply that amount at least by 25-26 or 26-27, but I can claim it as an application. When it comes to a numerical question, the deduction will be in the year 23-24. But I have to actually apply it in the year of receipt or by its subsequent year. That's what the department says. Are you with me? Again, one more thing is there. In 25-26, say I am applying this 10 lakh. I cannot claim it as an application again in 25-26 because I've already claimed it as an application in 23-24. Deemed application I've already claimed. So for one application, only one deduction. So that's why department say in 25-26, when I'm actually apply it, Don't claim it as a deduction again. Are you with me? This is point number 1. Now, second one, any other reason. What exactly is this any other reason? Let's understand. So, listen, any other reason. Any other reason simply means, say for example, late receipt is an example. Late receipt. Say for example, today is 31st March. 31st March 2024. I received say 50 lakhs as a donation. I received what? 50 lakhs as a donation. I won't be able to apply this entire 50 lakh by today because we only have one day to spend. Yes or no? It is impossible for any person to spend this much amount of money. I mean, normally it is like that. Okay, if you are awaiting a huge expenditure, then it is fine. Normally, within one day, spending 50 lakhs, it's possible. You go to a mall, then what will happen? Then you will end up in a lawn. Okay, even 50 lakhs won't be sufficient. But normally it is not that possible. So, what department say? In case of late receipt, this 50 lakhs can be treated as a deemed application. Deemed application in the year 23-24. No problem. But we will set a condition. What is the condition? You have to actually apply. You have to actually apply this amount by 2024-25. That means by the end of next year, you have to actually apply this amount for your charitable object. This is what the department says. Are you all with me? So, the point is very simple. If an amount is received late, then that amount received shall be treated as a deemed application the year of receipt. On a condition that you have to actually apply this amount by next year. Okay, by next year you have to actually apply that amount. So, this is said to be deemed application in relation to a charitable or a religious trust. Alright, so moving on to the next one, this is said to be deemed application. Now, moving on to the next one. Next one is also a point related to application. So, please listen. While applying an amount, section 40A3 and section 40A1A shall be applicable. What do you mean by section 40A3 and what do you mean by section 40A1A? 40A3, what is that? Say for example, we are an orphanage and in this orphanage, every year a doctor will come and will have a health checkup of my members or my beneficiaries. Say you are my beneficiaries. Okay, every year a doctor will come and he will do a basic health checkup. For that, I am supposed to pay to the doctor rupees 1 lakh. I am supposed to pay how much? Rupees 1 lakh. I paid it in cash. Do you remember section 40A3? If a person is making a payment in a single day, the payment exceeding 10,000, otherwise than by way of account pay check, account pay bank draft, ECS, prescribed electronic modes, then that entire payment made shall be fully disallowed. Do you remember this? Similarly, if a trust is applying an amount and the single day amount that you are spending is 10,000 or more than 10,000, then the method of application should be either account pay check, account pay bank draft, ECS or through prescribed electronic mode. Say for example, I have made cash payment to the doctor and the amount is rupees 1 lakh. Now I cannot claim this 1 lakh as my application. Why? Because I violated section 40A3. If I am making a payment to the doctor of rupees 1 lakh, I have to pay either by way of account pay check or account pay bank draft or ECS or prescribed electronic modes itself. So while applying the amount, section 40A3 disallowance will be there for a charitable or a religious trust. Are you all here? If you are applying an amount, section 40A3 disallowance will come into picture. That's what they are saying. I hope that also is clear. Moving on. What is the next point? Section 40A1A also shall be applicable. You tell me what is section 40A1A. Say for example, I'm making a payment to a doctor. And I haven't deducted any TDS. You know payment to doctors 194J, professional service it is. So I have to normally deduct TDS at 10%. But I forgot to deduct any TDS. I've made payment to the doctor without deducting TDS. So you tell me what will happen. Section 40A1A says, say 1 lakh I paid to doctor without deducting TDS. So 30% of 1 lakh shall be disallowed. So 30% I cannot claim as application. 70% yes, I can claim as what? Application. 70% I can definitely claim as application, 30% I cannot claim as application. This is the point. So when you are applying an amount, both section 40A3 and 40A1A both will come into picture. Both are applicable when a trust applies their amount. I hope it is clear. Moving on to the next point again, which is also in connected with the application point. So the next point, listen, you are a trust and you are giving a corpus donation. You are a trust and you are giving a corpus donation. Okay, you are a trust and giving a corpus donation to another trust. To another trust. Okay, now, so you are a trust and you are giving a corpus donation to another trust. This corpus donation given, what is corpus donation? Donation with specific direction. Donation with specific direction. So you are a trust and you have given a donation to another trust with a specific direction. You tell me, if I am giving this 10 lakh, say I have given 10 lakhs to another trust, this 10 lakh will not form part of the total income of that recipient trust. Because it is a corpus donation and they have to invest that amount in specified mode, then that amount of 10 lakh will never form part of the taxable income of the recipient trust. So department say, so it is not allowed as a deduction for the donor trust because that amount will go untaxed. Otherwise, if this donor trust is given a deduction, then what will happen? One side it is a deduction and the other side it is not taxable also. So that will create a imbalance. So what department say, if a trust is giving a donation, trust is giving a corpus donation to another trust, the amount donated is never allowed as a deduction or application for the donor trust because it is not a taxable income in the hands of a recipient trust. Are you with me? Are you with me? Or you think like this, imagine the donor trust will give a corpus donation to another trust. That another trust will give a corpus donation to the donor trust. Then both the incomes will go untaxed. Yes or no? This is the way that this certain trust will design their transaction so that they can go out the impact of taxability. So it is not like that. If you are giving any corpus donation to another trust, not allowed as deduction. Now you will ask me one doubt. What if it is a normal donation? Say this trust has given 10 lakhs or we will take 20 lakhs as a voluntary donation. Okay, voluntary donation or normal donation to another trust. Can this donor trust claim this entire 20 lakh as a deduction? The answer was yes. Was yes. That means right now it is not like that. There is an amendment came in. So what department say? If a trust gives a donation to another trust, okay, if a trust gives a donation to another trust, then normal donation to another trust, then out of that entire 20, only 85% only you can claim as what? Deduction. Only 85% is only allowed as deduction. What is this 85%? Because imagine, out of this 20 received by the recipient trust, they will claim 15% as what? Accumulation. Yes or no? They will claim 15% as what? Accumulation. How much is 15% of 20 lakh? 3 lakh. Okay, out of the 20 lakh, they will claim a deduction for the 3 lakh. So the 3 lakh portion is going untaxed. So the donor trust, we will only give you a deduction of how much? 17 lakh. You have given 20, but we will give you deduction only for 17. Why? Because that 15 is going untaxed in the hands of recipient trust and hence we have no plans to give you a deduction for this. Are you with me? Are you all with me? So friends, we were discussing about the contribution given by the trust to another trust. So how about anonymous contribution? Anonymous donation given by a trust to another trust? Anonymous donation. No deduction because nobody know that you have given a donation to another trust. It is anonymous only. Alright. So in exam, if they trick you, if they write anonymous donation, then don't think that Sir told us only about corpus and voluntary. Sir didn't tell anything about anonymous. Okay, use your brain always, okay? Because anonymous, anyways, nobody knows that you have given a donation. So anyways, not deductible. So moving on to the next one, listen. So next one again in relation to application. Say for example, every year a trust will accumulate 15% of their income and they have to apply 85% of their income. Yes or no? this accumulation is just like a reserve. This accumulation is just like a reserve. Say every year they will accumulate 15%. Are you all with me? Say a trust have a lot of accumulations. In different year, a trust have lot of accumulations. Now the question, a trust have given a donation from this accumulated income. A trust have given donation in year 4, out of their accumulated income. Are you with me? If a trust is giving a donation from their accumulated income, then that donation is never allowed as application. If you want to give a voluntary donation to another trust, you give it from your current year 85%. Don't give a donation from your accumulated reserve. You are not supposed to give a donation from your accumulated reserve. That have to be kept separately. Are you with me? So what they are saying is, donation out of accumulated income not allowed as application. If you are a trust and you have given a donation out of accumulated sum, that is never allowed as application. So you have to give donations from your amount to be applied. That is, from the 85% you can give donation, and you can claim 85% of the donated amount only as application. You got it? You can only claim that 85% of the donated amount only as application. Two things are there. I hope that also is clear. Moving on to the next one. Say for example, you are a temple, mosque, church, gurudwara, etc., etc. You are a religious trust. Say for example, we will take the example of a temple. Say I am the main trustee of an old temple and you are all my members of this trust. Okay, you all are members of my trust. Say what I am doing is, I just want to renovate the temple. Okay, I have a plan to renovate this entire temple. So what I told you is, I'll keep a box here. I'll keep a box here. This is kind of a renovation fund. Renovation fund. I'll keep a box here. You all come donate to this particular box. You all put your amount to this particular box. So lot of members came and they give donation. Lot of members came and they have given me donation. Are you with me? If they are giving me donations, then these donations from different members will be treated as a corpus fund only. You don't have to treat it as what? An voluntary normal donation. If you are a temple or a gurudwara, mosque, church, etc., etc., voluntary contribution given by different persons to that particular trust for the purpose of renovation or repair of the above places shall be treated as corpus donation only. You don't have to worry about anything else. Are you all with me? Are you all with me? And once, say for example, once you have received this amount, and you are applying it for the renovation, you receive this amount and you are applying it for your renovation, then that again is not allowed as an application. Why? Because the receipt is treated as a corpus, not as an income. So its application is not allowed as a deduction. Are you with me? Alright. Now, moving on to the next point, that is also in relation to what? That is also in relation to application. Say for example, you got a corpus donation. What is corpus donation? Donation with specific direction. You got a corpus donation. That is not considered as income. Not considered as income. Okay, that is normally not considered as income. Now you have applied this corpus donation. You have applied this corpus donation for what? For, say for example, this donation you got for construction of a building. Okay, you have applied this donation for constructing building. Now my question is, can you claim, say 10 lakh you have applied. 10 lakh you have applied for construction of building. Can you claim this 10 lakh as a deduction? The answer is no. Why no? Because the receipt itself is not considered as income. Now, if that corpus donation is not considered as income, applying amount out of corpus donation is also not considered as application. If it is income, then its expenditure is application. If it is not income, then you cannot claim that expenditure as application. It is as simple as that. I hope that also is clear for you. Utilization out of corpus fund is not allowed as deduction. Now, let me ask you another doubt. Listen, say I took a loan. I took a loan for construction of building. I took a loan for construction of building. The loan amount which I took was 20 lakhs. The loan amount which I took was how much? 20 lakhs. So the point is you took a loan of 20 lakhs and you utilized it for construction of building. My question is this loan 20 lakhs considered as your income? You're taking a loan of 20 lakhs. You raise the loan of 20 lakhs. Is it your income? No. Now you tell me, now it is not your income. You have utilized this 20 lakh for the construction of the building. Can you claim that 20 lakhs utilization as an application? No. Why? Because the entire amount of loan that you took is not considered as your income. It is only a capital. You are utilizing the 20 lakh to construct a building. That utilization of loan amount that you have taken is not allowed as application. It is one way. If the in is income, then out is application. If the in is not income, out is not application. It is as simple as that. Now this 20 lakh utilization is not allowed as application. Now let me tell you one thing. Say this is year 1. Year 2, I repaid this loan. I repaid this loan. Say 10 lakh I've repaid. Can you claim this repayment as a application? Yes, because in year 2, you should have some revenue to repay that particular loan. In year 2, you should have some fund to repay that particular loan. So repayment as loan is definitely allowed as application. So the point is utilization of loan for a purpose is not allowed as application, but its repayment is definitely allowed as application. Are you with me? Utilization is not allowed as application, but its repayment is allowed as application. I hope that point is also clear for you. Now moving on to the next one, that is also is connected to our application. Okay, say for example, my current year income was 10 lakh. My current year income was 10 lakh. I can claim 15% as what? 1,50,000 as accumulation. So I have to spend minimum 8,50,000. I spend that entire 10 lakh. I have spent that entire 10 lakh. Are you with me? That is also fine. No problem. I can spend that entire 10 lakh. And I took something from, corpus also. I've spent more than that. But I can only claim 10 lakh. So I've claimed 10 lakh as my application. Now I'll end up in deficit. I'll end up in what? Deficit. This is called as a deficit. Can I carry forward this deficit to the future years and set it off as a loss? No. Because this 1,50,000 in a way you have already deducted. You think it mathematically. I had 10. I applied 10. Out of the 10, 1,50,000 is a kind of a blind deduction. I am supposed to apply only 8,50,000, but I applied entire 10. So I end up in deficit mathematically. But this deficit is not my loss. So I cannot carry forward it to future. So if I am incurring a deficit in 1 year, ignore the deficit because that is not your loss. Entire 10 lakh, you have expended that entire 10 lakh, that's it. Since there is a concept of accumulation 15%, you end up in a deficit. If there was nothing called an accumulation, then it would have been nil. Are you follow what I said? This is not a hardship for the assessee. Okay, mathematically only you end up in a deficit. So ignore the deficit. You cannot carry forward deficit to future. Yes, this is what the department say. I hope that point is also clear for you. Now, next one. Moving on to the next one. Listen. Say for example, 10 lakh was my income. 1,50,000 I can claim as application. 8,50,000 is the amount to be applied. So what I did is like, I utilized this 8,50,000 to purchase a plant and machinery. To purchase a plant and machinery for the trust. Okay, say generator. I bought a generator for the benefit of beneficiaries. Now I can claim that entire 8,50,000 as an application because application doesn't mean it has to be in revenue nature. It can be in capital nature also. Are you with me? So I bought a plant and machinery or a generator and I've claimed that entire 80 as what? Application. Now, can I claim depreciation on this plant and machinery again at 15%? Is it possible for me to claim depreciation on this plant and machinery? Not possible because once the cost of plant and machinery is already allowed as a deduction application, thereafter you are not supposed to claim depreciation on the same as a deduction. Not possible. That's what the department says. Are you with me? Once you claim the entire cost of a machinery or a plant or a building or whatever it is as application. Thereafter, depreciation you cannot charge it. Again, that's what the department says. I hope that point is also clear for you. Great. Now, moving on to the next one. Again, something in relation to the concept of application. Listen, say for example, 10 lakh was my current year income. 1,50,000 I have applied. 8,50,000 is the remaining amount. 8,50,000 is the remaining amount. So listen, I have to pay some salary. 5 lakhs was my salary. I have to pay salary to the supporting staff. Total salary was how much? 5 lakh rupees. But I haven't paid the salary. It is in a payable status. It's in a payable status and I'm maintaining books of accounts in mercantile system. Are you all with me? I'm maintaining books of accounts in mercantile system and this 5 lakh is payable. Can I claim this 5 lakh payable as an application? What department say? Not possible. If you want to claim some amount as an application, then you have to actually make the payment in the respective year. So, application allowed as deduction only on actual payment basis. That is, in the relevant PY itself, you have to make the payment. Okay, say this happened in 2023-24, okay. I've made the payment on 15th April 24. I've made the payment in 15th April 2024. Then what will happen? 5 lakh is not allowed as an application in 23-24. But I can claim that 5 lakh as an application in 24-25. When I actually make the payment in future, I can claim that payment as a application in the year of actual payment. It is something similar to 43B, but not exactly like 43B. 43B, you have time for making payment up to due date of filing return. Here what they are saying is you have to make the payment within that PY itself. If you are not making the payment in the relevant PY, then in future when you are making the payment, you can claim it as a deduction or application, whatever it is. Are you all with me? Is that point clear? Super. Moving on. Now, moving on to another thing that is also in relation to application. Let's understand what exactly is that point. So, listen, say for example, say I am a trust, my income is 1 crore. My income is how much? 1 crore. And I want to construct a building. And this Ambanis, Adanis, nobody is visiting our trust. So, nobody is about to give me a huge donation. Okay. So, I myself have to save more money to construct the building. But there is a problem. What is the problem? Every year I can only accumulate 15%. 15% means 15 lakh. Every year I can only accumulate 15 lakh. Yes or no? So, if you are a trust and you want to accumulate more than 15% in a year, possible, but subject to certain specific conditions. This is called as what? Conditional accumulation. Conditional accumulation. So, please listen. Let's understand what exactly is this conditional accumulation. So, listen. A trust can accumulate more than 50%. So, all the theory is there. So, we will stick on to the chart now. It is conditional accumulation. Where is it? Yeah, this is it. So, listen. A trust can accumulate their income over and above 15% if certain conditions are satisfied. If you satisfy all the following 4 conditions, you can accumulate more than 15% in a year. Let's understand what all are the conditions. Number 1, the trust should furnish a statement in form number 10 at least 2 months prior to the due date of filing return to the assessing officer stating such extended period of accumulation. So, first of all, what you need to do is, before filing return, at least 2 months prior to the due date of filing your return, you should submit form number 10 to the assessing officer stating that I want to accumulate more than 15%. Are you with me? So, this administrative point it is, you need to submit the form number on time. Second condition, the purpose for which the income is being accumulated or set apart should be stated in the form. What is my purpose? I want to construct a building in year 4. So I am saving more than 15% this year. So please allow me. The purpose of this accumulation have to be clearly mentioned in that form number 10. That's what the department says. Number 3. Maximum period of extension shall not exceed 5 years. Maximum you can extend or you can conditionally accumulate it only up to 5 years. Within 5 years, you have to utilize it for the respective purpose. You are accumulating more than 15% for a particular purpose. You have to utilize it for the particular purpose within 5 years. So the maximum period of conditional accumulation is for how many years? 5 years. Moving on. The money so accumulated or set apart should be invested or deposited in mode specified in section 11 subsection 5. You have to invest that amount in specified mode. Both the normal accumulation, yes, normal accumulation and conditional accumulation have to be invested in specified mode under 11 subsection 5. You are not supposed to keep the money with you. What if you are keeping the money with you? Now, you know what will happen, okay? The trustee or the sponsor requires some urgent funds, they will utilize that particular amount and they will pay it off. Rolling the funds, that will happen. Okay, so we are saying you have to invest whatever amount that you have with you in specified modes. You are not supposed to keep that amount with you. That's what they are saying. Are you all with me? Alright, so this is how you have to deal with the conditional accumulation. I hope it is also clear. Now, till now, we were discussing about certain points in relation to application. Now let's understand something in relation to consequences to failure or consequences on failure to satisfy the condition of accumulation. Okay, this is actually an important theory. This is an important theory. So let's understand what exactly is the purpose of this respective theory. So listen, let's understand consequences on failure to satisfy conditions of accumulation. So friends, listen. This is called as violations under section 11 subsection 3. Are you all listening? This is said to be what? Violations under 11 subsection 3. So we'll make a chart. So violations under section 11 subsection 3. Okay, let's understand what is this violations under 11 subsection 3. So point number 1, if accumulated income is applied to purposes other than charitable or religious purposes, then such income shall be deemed to be income in that previous year. That simply means, listen, first violation. These are certain violations. The consequences we will study later. Okay, so listen, say for example, if you are a trust and you have accumulated amount, that is 15% of your taxable income every year. Now, this accumulated fund have to be applied for your charitable or religious purposes only. You are not supposed to apply it for any other purposes. If you are applying this for any other purpose other than your charitable or religious purpose, that's why other purposes. Okay, if you are applying it for other purposes, it will be considered as a violation. Violation number 1. We can say violation under 11 subsection 3. So what is violation under 11 subsection 3? You are accumulating an amount. Why are we letting you to accumulate an amount this year? Because that is only for you, for your future needs. So you have to utilize that amount for your future needs only. If you are applying it for some other purpose, it will be considered as a violation. Consequences are coming. Okay. Number 2, second violation. What is second violation? If accumulated income ceases to remain invested or deposited in modes specified under 11 subsection 5, then such income shall be deemed to be income in that previous year. So please listen. If accumulated income ceases to remain invested or deposited in modes specified under 11 subsection 5, then such income shall be deemed to be income of that previous year. That simply means, I've told you, all the accumulated amount have to be invested in modes specified under 11 subsection 5? Yes or no? If you have withdrawn the money, then what will happen? It will be considered as a violation, and that is violation number 2. If accumulated amount is ceases to remain invested or deposited in mode specified under 11 subsection 5, then such income shall be deemed to be income of that previous year. You need to invest it and keep it over there. If you are withdrawing the money or you are not investing the money, then that will be considered as a what? Violation only under 11 subsection 3. I hope it is clear. Then point number 3. Let's understand what exactly is violation number 3. What is violation number 3? Listen. If accumulated income, that is conditionally accumulated, is not utilized for the purpose for it is accumulated or not utilized within the time specified, that is 5 years maximum, then such income shall be deemed to be income of the PY being last of the previous year of the period for which income is so accumulated. That simply means, listen, if you are conditionally accumulating an amount, you must mention the purpose. Yes or no? And plus there is one more condition, you have to maximum you can conditionally accumulate it for the upcoming 5 years. Now, if you are applying it for other purpose, or if you are not applying it within 5 years, in both the cases, it will be considered as again a violation. You have to apply it for the respective purpose only, and you have to apply it within 5 years as well. Both have to be followed. Friends, one more thing is there. Say, I plan to construct, my planning was, or I'm actually or intended to, accumulated more than 15% or conditionally accumulated my amount for the purpose of constructing a building in future. That was my intention. That was my intent. But in future, Ambani came to my trust and given me a huge donation. So what will happen? When I got that huge donation, I don't want that accumulated money to be utilized for my building. In such a scenario, what I can do? If I want to change the purpose, then I should intimate it to the assessing officer that due to these things, now I am not planning to construct a building, but I am changing my purpose. I am utilizing it for the benefit of my beneficiaries in future. I can change the purpose, but I have to intimate it to the department and take their approval. Before that, if I am changing the purpose without the approval, that will be considered as a violation. With approval, it is permissible. Without approval, it will be considered as a violation only. Point number 4. If accumulated income is credited or paid to a trust or a fund or institution registered under 12AA or 12AB or section 1023C, such income shall be deemed to be income in that previous year. So listen, point number 4, what they are saying is all the accumulated income what I've done, I've given it as a donation to another trust. Accumulated income, if I am giving it as a donation to another trust, that also will be considered as a violation. So there are 4 violations. Which all are the 4 violations? Number 1, accumulated amount is applying for some other purposes. Number 2, accumulated amount invested but you withdrawn the investment or you haven't invested it. Number 3, conditionally accumulated amount have been utilized for some other purpose or I haven't utilized it within 5 years. 4th violation, accumulated income have been given as a donation to some other trust or institution. In all these 4 cases, it will be considered as what? Violation. And there are certain huge consequences for the violation. So friends, the point is, these all are considered as what, friends? These all are considered as violations under 11 subsection 3. When we move further, there are certain consequences for this violation that we will learn. So whenever I say violations under 11 subsection 3, 4 violation. Which all are the 4 violation? Accumulated income applied for some other purpose. Accumulated income you withdrawn from 11 subsection 5. Conditionally accumulated amount, change the purpose without approval, or you haven't applied it within 5 years. Then accumulated income given as donation to another trust. So all the 4 are related to accumulation only. These 4 are related to what? Accumulation only. Great. So moving on to the next concept, you should know what exactly, these are the main concept. Now, not yet over. We have some more to come. Okay friends, now we are about to discuss another concept that is called as denial of exemption. So the last thing which we have discussed is violations under 11 subsection 3. Now we are about to discuss a concept called denial of exemption. You tell me, what do you mean by denial of exemption? That simply means in the following circumstances, you will not get the benefit of application. Denial of exemption, that means if you apply, you will get that amount as an exemption. Even if you apply, you will not get the following amounts as deduction, or we will not give you the benefit of any exemption in the following circumstance. Let's have a detailed discussion in each and every matter. Situation number 1. Income not eligible for exemption under 11 and 12 in the following circumstance. What do you mean by income not eligible for exemption? The following income, you cannot claim any exemption. You cannot claim the benefit of accumulation and application. What is item number 1? Income from property held under a trust for private religious purposes. That simply means, say for example, you are a trust. You have a property. From whatever income that you are earning from this property, you are utilizing only for a private religious purpose. You are not utilizing it for general public purpose. You are restricting that utilization only for a private religious purpose. The entire income, whatever is the entire income, on this entire income, you cannot accumulate, you cannot apply. You cannot claim the benefit of accumulation, you cannot claim the benefit of application. That entire income shall be fully taxable separately. You will not get any benefit under 11 and 12. Are you with me? If you have a property and you are using that income only for a private religious purpose, that means you are restricting the usage only to certain group of people based on religion. That is not acceptable. That entire income, you are not eligible for any accumulation and application. Moving on. The trust has been established for the benefit of any particular religious community or a caste. Income thereof will not be eligible for exemption under 11. If you are created a trust for a particular religion or a caste only, then you are not eligible for any exemption under section 11. But there is an exception. What is that exception? Creating a trust for the benefit of scheduled caste, backward classes, scheduled tribe, women and children are eligible to claim as exemption. If you have created a trust for the benefit of scheduled caste, backward classes, scheduled tribe, women, children, then definitely no problem, you can claim the benefit of accumulation and application. You should not regard it, you should not consider it as a particular religious community, caste or something. These are exceptions. Apart from this, if the beneficiaries are a closed community either based on religion or a caste, then you are not supposed to claim the benefit of accumulation and application. That's what the department say. I hope this much is clear. Moving on. First of all, you have to be a public trust, then only you can claim the benefit of exemption. What is public trust? Your beneficiaries are general public. If you are restricting it in a way, then you are not eligible for any exemption. Moving on. Any part of income of a trust utilized directly or indirectly for the benefit of interested person. This is actually a little bit important, okay? If a trust is utilizing any of its amount for the benefit of interested person, then what will happen? If you are utilizing any amount for the benefit of interested person, then the department say, for that amount, you cannot claim the benefit of accumulation and application. That have to be taxed separately. Are you with me? So, if you are utilizing any amount for the benefit of interested person, let's understand then what will happen. So, the following are the interested persons mentioned under 13 subsection 3. So, let's understand who all are the interested person under 13 subsection 3. Number 1, who is the first one? Author of the trust or founder of the institution. Say you are author of a trust or founder of an institution, then you are considered as an interested person. What do you mean by author or founder? We call it as a sponsor, just like the promoter in a company. There is a sponsor group. We call it as author. That author, if you are utilizing some amount for the benefit of that author, he is considered as a interested person and you will not get the benefit of any exemption, application, etc. Number 2, any person who has made a substantial contribution to the trust or institution. That is a person whose total contribution up to the end of relevant previous year exceeds 50,000. So you are a person who is contributing more than 50,000 in a year to the trust. You will be considered as a substantial contributor. Substantial contributor. If you are a substantial contributor and the trust is spending something for that particular contributor, then it will be considered as amount spent for the interested person's benefit. So listen, what is the problem with a substantial contributor? Imagine a situation. I am a person and you are a trust. I am giving you 1 lakh rupees as donation. Then I will claim a deduction under 80G. Then I am telling you, you spend that amount for the benefit of me or for my relatives. You spend that for the benefit of me or for my relatives, then you can claim it as an application. They all benefit. Are you with me? Not permissible. If you are a substantial contributor, don't accept any benefits from that particular trust. That's what the department says. Moving on. Where author, founder or a person making substantial contribution is an HUF, then any member of the family. Say you are an author, founder or a substantial contributor, you are an HUF. Okay. Any members of the family, the trust is spending trust is expending something for the benefit of any members of your family, that also will be considered as an amount expended for the benefit of interested person. Then any trustee of the trust or manager of the institution. You are a trustee or manager, you will be considered as an interested person. Moving on, any relative of such author, founder, person, member, trustee, manager as referred above. What do you mean by any relative of author, founder, person, member, etc.? Say for example, I am the sponsor. The trust is not supposed to spend anything for my benefit as well as my relatives' benefit. Now the question is, who is my relative? Let's understand who all are my relatives. So there is a definition. Relative means for an individual, it is spouse. That means his wife. Then brother or sister of the individual. That individual's brothers and sisters. Then brother or sister of the spouse of the individual. In-laws, brother-in-law, sister-in-law, etc. Then any lineal ascendant or descendant of the individual. What is lineal ascendant? Father, grandfather, mother, grandmother, descendant, son, grandson, daughter, granddaughter, likewise. Or any lineal ascendant or descendant of the spouse of the individual. That means your wife's father, grandfather, your wife's son or grandson, whether it is your son or not, doesn't matter. That means in second marriage, that your partner may have another children. Okay, that is also perfectly fine. Okay, don't put any masala to that. Okay, yes. Coming back to the point, what is that? Spouse of persons referred in B, C, D, E above. What is B? Say for example, your brother is your relative. Brother's wife is also your relative. Your sister is your relative. Sister's husband is also your relative. Your brother-in-law is relative. Brother-in-law's wife is also your relative. So any person referred in B, C, D, E above, their spouse also will be your relative. That's what they are saying. Why they are not saying A? Your spouse is your wife. Wife's spouse is you yourself. Okay, so they don't have to mention it. That's why B, C, D, E alone. And what is G? Any lineal descendant of brother or sister of either individual or spouse of the individual. What do you mean by that? Say for example, your brother's son, grandson, or daughter or granddaughter. Your brother's father and grandfather is your father and grandfather. So they don't have to mention that. That's why they are only saying descendants for your brothers and sisters. I hope you got my point. So this is in relation to an individual. If the person, that means if the substantial contributor, founder, member, etc. is an individual, then the trust is not supposed to apply anything for the benefit of that individual's relative as well. And what is the last point? Can you read the last point? Any concern in which any of the persons referred above has substantial interest. That is, at least 20% voting power in the case of a company or 20% profit sharing ratio in other concerns. Very simple. You are the sponsor. You have 20% stake in a company. You have 20% or more stake in, say, Tata Capital Services or Tata Consultancy Services. Okay, 20% or more stake in Tata Consultancy Services. Trust is not supposed to spend anything for the benefit of sponsor, as well as the trust is not supposed to spend anything for the benefit of a company where any of the persons mentioned above have a substantial interest. Instead of directly accepting the benefit, I am telling you give this to the company where I have shares. Not possible. That is also considered as interested person. Now you tell me, what if you are a trust and you are spending something for the benefit of interested person? You will not get the benefit of accumulation and application. That entire accumulation and application concept is thrown away. Are you with me? Now. One more thing. Any income of a trust if deposited in impermissible modes. What is that? You are investing the amount in any mode other than 11 subsection 5. Then that amount, no accumulation, no application. That also have to be taxed separately. Are you with me? Are you with me? Moving on with the next thing, friends. Listen. So, income of a trust has applied for the benefit of interested person. Consequences are. So, please listen. I've told you this interested person is an important thing. Yes or no? If a trust is applying their amount for the benefit of interested person, what exactly are the consequences? This is not a separate section. I've created a flowchart for a better understanding. Okay, this is only for the understanding of students. This is not a separate section or not a separate paragraph and all. So, let's understand. What if a trust is spending something for the benefit of interested person? The trust is spending something for the benefit of interested person. Let's see what will happen. So, listen. Income of a trust has applied for the benefit of interested person. Consequences are, if you are applying some amount for the benefit of interested person, there are certain consequences. Now, let's understand what all are the consequences. First consequence, what is that? Such income cannot be claimed as application. You are spending something for the benefit of what? Interested person. There is an outflow of money, but that cannot be called as an application. You will not get the benefit of application. That's gone. Second one, such income shall be deemed to be specified income under 115 BBI, taxable at 30%. That simply means such income shall be deemed to be a specified income. That means that amount I am spending and I am applying for the benefit of specified person shall not form part of the taxable income. It have to be treated as a separate income and you have to tax it at 30% separately. Are you with me? Third consequence, there is a penalty. What is a penalty? Under section 271 AAE, 100% of the income so applied where the violation is noticed for the first time during the PY. If you are noting that violation for the first time in the PY, then how much is the penalty? The 100% of the amount. You are applying 10 lakh for the benefit of interested person, your penalty is 10 lakh. What if it's a subsequent violation? That means you are continuously doing it, just 200%. For spending 10 lakh, you have to pay 20 lakh as penalty. Plus, income tax will come at 30%. Are you with me? This penalty is an extra amount that you have to suffer from your pocket. And there is one more consequence. What is the last consequence? That is for the recipient. What is that? Non-applicability of relaxation under 56 subsection 2 clause 10. For the recipient, such benefit shall be taxable under 56 subsection 2 clause 10. So listen, say I am a trust. I am giving say 2 lakh rupees to my sponsor. First of all, for the trust, this 2 lakh not allowed as application. Then this 2 lakh have to be taxed separately at 30%. Then I have to pay a penalty of 2 lakhs. These are the three consequences for trust. There is one more consequence for the recipient. What is that consequence? The sponsor received 2 lakh without any consideration from the trust. That's why benefit of the sponsor. The sponsor took 2 lakh from the trust. and this is considered as an income taxable under section 56 subsection 2 clause number 10. Normally under 56 subsection 2 clause number 10 there is an exception. Any benefit that you receive from a trust is not taxable under 56 subsection 2 clause 10, but you will not get that particular exception benefit under 56 subsection 2 clause 10. It will be fully taxable in the hands of sponsor under 56 subsection 2 clause 10. Are you with me? So these are the consequences of applying some income for the benefit of sponsor or founder. These are the consequences. I hope this much is clear for you. Yes, now let's solve some questions, okay? But before that, one more thing is there. That is 115 BBI. Let's study that as well. So listen. Taxation of specified income chargeable to tax by charitable trust or institution, section 115 BBI. Let's understand what exactly is this 115 BBI. So friends, listen, meaning of specified income, that's what we are about to discuss right now. So let's understand what is this specified income. So first of all, listen, for certain specified incomes, the rate of tax will be 30% under section 115 BBI. One of those specified income is amount applied for the benefit of interested person. Are you with me? If a trust is applying some amount for the benefit of interested person, that will be considered as a specified income. Okay, along with that, there are certain other items also that comes under the definition of specified income. That's what we are about to discuss right now. So, number one, what is item number one? Income accumulated or set apart in excess of 15% of income, where such accumulation is not allowed under any specific provisions of the Act. That simply means if you are accumulating more than 15%, then you have to satisfy certain conditions. Do you remember conditional accumulation? You have accumulated more than 15, but you are not satisfying the respective condition. You are saying it is a conditional accumulation, but you haven't filed the form, or you have done some mistake in filing the form, or you have filed the form after the date. If you are doing something like that, then what will happen? Huge consequence. That amount which is conditionally accumulated that does not fulfill the conditions under the Act will be treated as a specified income, and you are supposed to pay taxes at what rate? At 30% on that particular portion. Are you with me? Are you all here? Normally, the trust have to pay taxes at the applicable slab rate for an individual. That is up to 2,50,000 nil, 2,50,000 to 5%, 5 to 10, 20%, 10 above 30%. This is the normal slab rate applicable for a trust. But specified incomes are taxable at flat rate at 30%. So, one of the specified income is income accumulated or set apart in excess of 15% of income, where such accumulation is not allowed under any provisions of the Act. I have given a small explanation. Means that if a trust accumulates income beyond specified limit without any legal authorization or justification, it will be deemed to have been received that income and will be liable to pay taxes on it at 30%. Second violation, deemed income on account of violation of certain conditions stipulated for accumulation of income under section 11 subsection 3. Do you remember violations under 11 subsection 3? Today only we have discussed violations under 11 subsection 3. 4 violations in relation to accumulation. Number 1, what was that? You have accumulated an amount and now you are applying it for something which is not for your object. Number 2, you have withdrawn the accumulated amount from the specified modes. Number 3, you have conditionally accumulated an amount and you have changed the purpose without authorization, or you haven't utilized that amount within 5 years. What is point number 4? The last one, you have given a donation out of your accumulated amount. All those 4, 11 subsection 3, do you remember this item? Where is that? These 4 items, violations under 11 subsection 3, trust accumulated an amount and applying for any other purpose, accumulated an amount, withdrawing the money from specified modes, conditionally accumulated the amounts, change the purpose without authorization, or you haven't applied it within 5 years, accumulated an income and give it as a donation to another trust. All these 4 are violations in relation to accumulation. If you have committed any of those 4 violations, then what will happen? That violated amount will be considered as a deemed income under 11 subsection, under 115 BBI, not subsection, 115 BBI. At what rate? 30% rate. Are you with me? So, again I'll read that. Deemed income on account of violation of certain conditions stipulated for accumulation of income under 11 subsection 3. Now, what is the next one? Deemed income on account of violation of deemed application. There is a deemed income on a violation of deemed application. What is deemed application? Amount accrued but not received or late receipt. These are allowed as deemed application. But there was one condition. What was the condition? Amount accrued but not received have to be actually applied in the year of receipt or by its subsequent year. Late receipt income have to be applied at least by the next year. That's subjected to that condition only. It is allowed as a deemed application. What if you are not applying it for the respective purpose in future? Then in future, it will be considered as a deemed income taxable at 30%. Are you with me? Say for example, 31st March 2024, I have received 10 lakh. Due to late receipt, I have considered as my deemed application. Then I must apply it in the year 2024-25 itself. I haven't applied it, then this 10 lakhs will be taxable at not slab rate. It will be taxable under section 115 BBI at 30% rate. This is what the department says. Are you all here? Moving on. What is the next violation? Any income which is not exempt under section 11 on account of funds of the trust or institution not being invested in the forms or modes specified under 11 subsection 5. That simply means any income earned by the trust or institution from investments made out of specified forms and modes under 11 subsection 5 would be taxable. Say for example, any income which is not exempted on account of funds of a trust or institution not being invested in the forms or modes specified under 11 subsection 5. Simple example, corpus donation I received. I haven't invested it in 11 subsection 5 modes. Then that will become my income. That income is subjected to not slab rates. It is subjected to 30% rate under 115 BBI because it is considered as a impermissible mode of investment. So what they are saying is, any income which is not exempted under 11 on account of funds of trust or institution not being invested in forms and modes specified under 11 subsection 5. That's what they are saying. I hope you got my point as well. A receipt have become your income due to non-investment in 11 subsection 5. Corpus donation you haven't invested in 11 subsection 5, then it will become your deemed income taxable at 30%. That's it. Then next item that we have already learned. Any income which is applied for the benefit of interested person. You are applying any amount for the benefit of interested person, that will be considered as your deemed income taxable at 30%. Last item, any income derived from a property held under a trust for charitable purpose which tends to promote international welfare in which India is interested, to the extent to which such income is not applied towards charitable purpose outside India. Say for example, you are a trust and your objective is international welfare. International welfare in which India is interested. Okay, so your objective is international welfare where India is interested. If you are saying this is your object, then all the income that you receive in a year have to be applied for that respective purpose in that year itself. Okay, you are a trust which promotes international welfare and you are receiving a amount, all the amount have to be applied in that respective year itself. Any unapplied amount will be subjected to tax at 30% under section 115 BBI. Are you all with me? Now I want all of you to just go through these conditions mentioned under 115 BBI. So please go through these conditions. Now for all this income, what is the rate of tax, friends? As you all know, it is taxed at what rate? 30%. Now the twist is, you cannot claim any deduction or expenditure from these incomes. These are flat rate taxation. From these incomes, you cannot claim any expenditure as a deduction. The full income is fully taxable. Now friends, we have learned a lot of things under this charitable trust. How will you incorporate everything in an exam question. How are you planning to write your answer if the exam question is a numerical question? There is a detailed chart. This chart will actually help you to solve any type of numerical question that they are testing in relation to computation of total income and tax in relation to a trust. Okay, so let's discuss this discuss this chart one by one. First of all, what you need to do? What is the first thing to do? Write the gross income from property held. Whatever properties you have, you write the gross income from the property held. Now, what is the second step? If you have any expenses from activities, that means if you have any direct expense for earning that particular gross income, you can directly deduct it. Say for example, the trust is running a business. That is permissible. The trust can undertake a business or trust can own a business undertaking. Absolutely no problem. So we have a trust and there is a shop for us. There is a stationery shop. All the sales or all the money that we are getting from the stationery shop, we are utilizing it for the object of our trust. So the stationery shop, there will be sales as well as expenses. The building rent, then the staff salary, then the purchase, those you can directly deduct from the gross income. Only the net income will be considered as the income from property held by the trust. So gross income minus direct expenses. This is not the direct expense of the trust. This is the direct expenses to earn the income. Okay. Then add normal donations and part of anonymous donation that are not covered under section 115 BBC. What is that? Normal voluntary donation and anonymous donation specific limit you have to add. Then you will get net income from property held by trust. From that you can accumulate 15%. The remaining 85% have to be applied for the benefit of trust. Then amount expended for the object of the trust you can deduct, but that is on the basis of actual payment. Then amount set apart for future application. What do you mean by year marked and set apart? That means conditionally accumulated. We call it as year marked and set apart. Year marked and set apart means you are, what do you say, conditionally accumulating more than 15% for your future objectives. That is also allowed as a deduction. Non-application due to amount received on the last day of the previous year, late receipt, deemed application. Then amount accrued but not received, that is also deemed application. These items you can deduct. The remaining is income not applied. Now, along with that, add certain items. What are the things that you have to add? Number one, can you read? Unutilized amount set apart from previous year and the time period of deferment expired, that is taxed in the 5th year. Do you remember conditionally accumulated amount in last year's? Maximum conditional accumulation shall be for 5 years. This is the 5th year and there is some unutilized balance that have to be treated as an income over here, not over here. It should come under. Are you with me? But why? Because from that you cannot again claim accumulation. Yes, from that again you cannot claim accumulation. That's why it's under. Okay. Now moving on. Add amount spent for the benefit of interested person. That also should come here. If you are spending some amount for the benefit of interested person, the entire amount have to be added here, not upper. Are you with me? Now add income set apart in excess of 15% of the income where such accumulation is in violation of condition under section 11, condition under 115 BBI. All the other incomes where there is a violation under section 115 BBI should come here. Then other specified income under BBI, all the other items also should come over here. Then anonymous donation covered under BBC also should come here. If you have any anonymous donation, that also should come over here. And finally you will get income, that is taxable income of that particular trust. Now how do you compute the rate of tax? Anonymous donation BBC 30%. Income taxable under BBI taxed at 30%. Other income normal slab rate that is applicable for individuals. Say for example up to 2.50 nil, 2.5 to 5, 5%, 5 to 10, 20, 10 above 30. There is no 115 BBC for trust. Okay. So it is applicable only the normal old slab rates. Are you all with me? Is that point clear? have a plain reading over this particular computational format. Just go through this format. So friends, now let's solve some questions in relation to the theory that we have learned in the morning. So I want all of you to go through this question number 12, which is in page number is not relevant. Take this question number 12, go through this question number 12, read the question and try to give me the answer, okay? It's a fantastic question. Okay friends, so let's go through this question and compute the answer. A public charitable trust registered under 12 AB runs a hospital. Runs a hospital. It furnishes you the following information for the year ended 31st March 2024. So let's read it further. The gross receipts from hospital. So we will write gross receipts from hospital, and how much is that? 425 lakhs. Income from business incidental to the main object 2 lakh. They can have business but no problem, but it should be incidental to the main object of the trust. So business income 2 lakh. Then voluntary contribution received from public 32. It includes corpus donation 3 lakh and anonymous donation 5. There is a note. Voluntary contributions are included in the gross receipts given in point number 1. So all the voluntary contributions are mistakenly added in the gross receipts, that is 425. So what we need to do is, let's remove that entire 32 from here. How much will be the net then? How much is 425 minus 32? Help me with the math. 393 lakh. Let it be there. Now, how about the donations? Voluntary contributions received from public is 32. It includes corpus 3 and anonymous 5. So, how much is the normal voluntary contribution? Normal donation is, say 32 is the total minus 3 minus 5. That will be 24. How much is the specific limit of anonymous donation? Let's see. For the specific limit, you need to take the total donation of 32 into 5%. How much is 32 into 5%? 1.60 lakh. Or anonymous donation received, or rupees 1 lakh, whichever is higher. And 1.6 is the higher, so we will consider it 1.60 lakh. Now, how much is the actual anonymous donation? Actual anonymous donation is only 5 lakh. So, minus specific limit 1.60. How much is the remaining? 3.40 lakh is the remaining. That will be taxable under section 115 BBC at 30%. Let it be there. Don't add it here. That we have to add it after the accumulation and application. Okay. So, what is next? Hospital operational expenses include 105. Since they are saying operational expenses, I am assuming it as their direct expenses for earning the income. So, operational expenses. There is an alternate view. Since the hospital itself is the trust, it can be treated as an application as well. So, it is an alternate view that you can adopt according to your understanding. Both are accepted. There are alternative views also. Either you have to consider it as a direct expense and you net it off from the income, or you can claim it as an application as well. Both are right. So, how much is the operational expenses, friends? 105 lakhs. Now, how much is 105? 393 minus 105? 288. Then it is other things are related to the application point. So, can you help me? How much is the gross income adding 288 plus 2 plus 24 plus 1.6? 315.60 lakh. Now, accumulation at 15%. How much is 15% accumulation? Come again? 47.30. 34. How much is amount to be applied?
268.26.
268.26. Now, let's deal with the actual applications. Which all are the actual applications? Number one, gross receipts in point number 1 includes 55 lakhs which was accrued but not received. So, we will call it as deemed application. 55. It is accrued but not received. Then, further a sum of 18 lakh was received only on 31st March 2024. 18 lakh received only on 31st March 2024. What to do? Again, deemed application, we can call it as late receipt because it received on the last day. How much is the amount? 18 lakhs. Then, trust set apart 80 lakhs for acquiring a building to expand its hospital. But the amount was paid in December 2024 when the sale deed was registered in its name. So, we are assuming it as conditional accumulation because the question is not saying that whether they have satisfied the conditions mentioned under. We are assuming that all the conditions in relation to conditional accumulation have been satisfied. So, we are considering it as conditional accumulation. How much is the amount? 18 lakhs. No, not 80 lakhs. Then, in June 2023, the trust purchased and installed computers, 28 lakhs. So, computer definitely allowed as application. And the rate of depreciation 40%. Thereafter, you cannot claim any depreciation. The trust incurred 35 lakhs for the purchase of laptop. Laptop is also application. 35 or 30, it's 35. It repaid a loan of 15 lakhs taken earlier for construction of hospital building. So, it is a repayment of loan. So, that is also allowed as application. How much is the amount? 15 lakh. Now, how much is the unapplied amount? Amount not applied. That is 37.26. Now, balance of anonymous donation. How much was the balance of anonymous donation? It was 3.6, right? 3.4. Yeah, it was 3.4, not 3.6. It was 3.4 only. So, how much is the taxable total income? 40.66 is the taxable total income in this particular case. I hope it is clear for you. So, let's solve one more question that is in relation to computation of rate of tax. This is only for the total income, but this is a fantastic question. So, yeah, just go through this question number 11. Go through this question number 11 and give me the answer. So, what is the question? Asha Memorial Trust running a hospital is registered under 12AB. Following particulars relevant for the previous year ended 31st March 2024 are furnished to enable you to compute tax liability of the trust. Income from running of hospitals 1425. So, we have to write the income first. Running of hospital 14.25. Then donation received including anonymous donation 3 lakh. So, voluntary contribution alone is how much? 2.75. Yes or no? Now, how much is specific limit of anonymous donation? Total donation is 5.75 into 5%. How much is 5% of 5.75? 750 or rupees 1 lakh, whichever is higher. So, obviously, it is 1 lakh. And how much is the balance anonymous donation? 2 lakh. Right? Yes. That will be taxable under BBC. Let it be there. Now, amount applied for the purpose of hospital 13. So, these are the total income. Can you help me in this math? How much is the total income? Exactly 18. 15% you can accumulate. How much is 15% accumulation? 2.70. So, amount to be applied will be how much? 15.30. Now, actual application. 13. Actual application, they are saying 13. Now, what is next? 2.3. The trust has accumulated 15 lakh in the year 18-19. So, in the year 18-19, they have accumulated 15 lakh for a period of 5 years. That means continuous conditional accumulation. The trust has spent 13.50 till 31st March 2024. So, 18-19 is the first year. So, they have accumulated in that year, conditionally accumulated in that year. So, first year will be 19-20, second year 20-21, third year 21-22, fourth year 22-23. So, this is the fifth year 23-24. So, you have to apply the entire 15. but you have applied only 13.5. So what will happen to the remaining? 13.5. So 1.5 will be income taxable under 115 BBI. So under section 115 BBI 1.50, and anonymous donations balance taxable under 115 BBC. How much is that? 2. So how much is the total income? 1 second. We haven't written the unapplied amount. Okay. So we will leave a gap over here. And how much is the unapplied amount? 15 minus 13. How much is the unapplied amount? It is 2.30 plus 1.5 plus 2. How much is the total income of the trust? 5.80. Now you have to divide this into 3. 2.30 to the slab, and nothing shall be taxable. Nil. Then 1.50 at 30%. How much is 30% of 1.5? 45,000. And 2 at the rate 30%. How much is 30% of 2 lakh? 60,000. So how much is the total of these two? 1 lakh 5,000. And cess at 4%. How much is 4% cess on this figure? 4,200. Add everything. 1 lakh 9,200. That will be the final tax liability of that particular trust. I hope it is clear for you.
To purchase recorded lectures and textbooks, visit our website www.cajoscurian.com.